Hello, this is Jan Lewis, global strategist at JP Morgan. The U.S. economy, global economy are recovering from the Great Recession, but growth is clearly too weak for the U.S. to solve a lot of the problems of high unemployment, high deficits, and deflation risks. The situation is clearly unacceptable to U.S. policymakers. That's why we've seen large-scale asset purchases by the Federal Reserve, and now also announced this week significant fiscal expansion, an extension of the Bush tax cuts, as well as a number of other tax reductions. The objective is to stimulate the economy, to create a takeoff speed. But this is actually going to work, because the odds are quite badly stacked against its success. And when we try to balance it out on net, maybe we're always too optimistic. We're willing to bet on the positive side. So what's the government trying to do? Well, it's looking at a situation where the main sectors in the economy, households, corporates, the banks, state and local authorities, they're all looking at each other. They're very wary of each other. None of them really wants to be the hero here and expand on its own. They're wary that the rest will not follow. Households are not spending that much because they don't have the jobs. Corporates are not hiring much because they're afraid the households are not going to spend. The banks are looking at those two and saying, not a great idea to lend a lot of money. And state and locals are under funding pressures and they're cutting back also. Now, government's objective is simply the federal government wants to be the hero. It's going to move out and expand and crank up the engine to get the other sectors to join in, and then you have a self-propelled recovery. That's the objective. Now, stacked against that is the usual crowding out. The more the government borrows, more bond yields rise. Now, it may not be a big problem this time because the corporates are not borrowing that much. They have a lot of profitability. However, there's an extra factor. It's really quite new, which is simply that the government is growing so fast. We have now the spreading euro sovereign crisis. Investors are quite wary of increased leverage. And as a result, we could see significant increases in bond yields as a result. In addition, the Ricardian principle remains alive, which says that why should you as a consumer spend more when the government cuts taxes, given that you know they're ultimately going to go up anyway. Particularly in this case, this is a one-year cut. So bad odds. On net though, when we add it all up, we're still to bet that there will be some success in boosting the economy. And that's because a lot of the money moving out of government debt, municipal debt, is moving into corporates. So corporate yields will remain relatively low. The Obama administration is also clear in making friends now with the corporate sector. And the corporate sector allegedly was unwilling to spend because they considered the current administration anti-business. Should not be the case anymore. And finally, most importantly, in the last few weeks, we've clearly seen economic activity data already surprising on the upside. We were already in the process of raising growth forecasts and do it more at the moment. What's the implication for your investments? Well, a stronger view is you're long, aggressively equity versus fixed income. I think equities will go up, fixed income is in danger here. The second position is we like non-financial corporates relative to government debt. Fantastic difference in balance sheets, and spreads are still wide relative to where they normally are in expansion. The third one is we're long commodities, a select group. There's oil, there's copper, tin, agriculture, all areas where there's significant supply constraints relative to even modest increases in demand. Finally, we still have the overweight emerging equities versus developed markets, but we're softening this a bit. The movement into emerging markets was seen because there's so much better growth outlook over there. But now, with the U.S. boosting its own growth, probably the flow into emerging markets is going to soften. So we still have a trade on, but it's not our biggest one anymore. I thank you.